right, let's go through another example. So we've been working our way through the different types of adjusting journal entries. We're going to see there's 5. We said in a previous slide that these 5 follow the following guidelines, right? We're never going to see cash involved. Equipment's not going to be impacted. We must update an expense or revenue account in each adjusting entry, and the offset will be an asset or a liability account. All right, let's look at another example. Here we have our company has received a customer prepayment at the beginning of the month for a series of nutritional classes that we as a class provider will perform. At the end of the month, the company has conducted half of these classes. So with some of these, it helps me at least to think of the original entry that we did in chapter 3. Okay, so the original entry at the beginning of the month, when we received this cash, we debited cash for $2,000. That was at the beginning of the month. We did an entire series of classes on that one day when we received the prepayment. So we correctly put it to the unearned revenue account. Because when we're not sure about what account to put it to, we use our GAAP rules. And the revenue recognition rule, the revenue recognition principle, an important principle in accounting, says if we haven't conducted the class, we cannot call it revenue, right? Which is why we put it to unearned revenue, which is a liability account. Okay, so that's the entry we made at the beginning of the month. Now it's saying at the end of the month, or in the month of August, we've now conducted half of these classes. When you hear that word conducted, completed, performed, that means earned. Earned means we can record the revenue. Why? Because the revenue recognition principle says if we've earned it, we can call it revenue. We want to increase revenue. You do that with a credit. We have earned, I guess I should do it down here where I actually have the template, sorry. Do it down here, revenue. We have earned a half or $1,000. You increase revenue with a credit. And think about what your debit offset is going to be. Okay, we know that it has to either be an asset or a liability. Well, we recorded a liability at the beginning of the month. And now if we debit it, we decrease it, which is exactly what we want to do. We have reduced the liability. How? We've performed and now earned that revenue. So we no longer owe the client for that if we didn't hold those classes, for example. So to adjust for previously received payments, now earned. So that's your adjusting entry for unearned revenue. It's always going to be these accounts. You always want to increase the revenue account, decrease the liability. You can go back to our guidelines just to make sure we're still holding true. There was no cash in that adjusting entry we just did. Obviously, equipment was not involved. We did have a revenue account involved. Yep. And then the offset was the liability. Yep. All right. Good job. I'll see you in the next one.